Morning Street. I'm Edwin Allen Parker, and I am the Informant. It's another interesting week this week. Producer prices came out, and not surprisingly, when you look at commodity prices, they were up. And I think a lot of that's got to do with just people who would normally be putting their money in other places of the market are now going to commodities because the other hard assets, they're just not getting any kind of return on them at all. So that extra demand's pushing up commodity prices. But at any rate, we're going to be looking at a company this week by the name of Walgreen, ticker symbol WAG. So Street, if you got your spreadsheets and your coffee ready, let's get it on. We're going to start with the capital structure on this company. This is an excellent company, I think, in my estimation. The company's 100% equity. They got no debt at all. Well, they've got payables, but no long-term debt. Their return on capital, they had a good return on capital. It increased value. But their return on capital is falling. So is their risk premiums are falling. But still, if you look up here, you've got 15.7% in risk premium. That's really good. There was no change in their capital structure over the last reporting period. Continuing on down further into the capital section here, they've got $1.5 billion in treasury stock. That's an average price of $43.82. When you look at your market price up here of $36.45, it's not likely they're going to be issuing any of that treasury stock at a loss here in the near future. So I wouldn't be looking at any dilution from earnings right away unless it comes from the $1.9 million they have in options. If those options get exercised, that would cost shareholders another penny a share, but it also adds $69.1 million to the company coffers. Last year's options cost shareholders a penny a share. That was $10.1 million in hang. The company, if you were to invest in this company $1,000, they would return you 5.6%. That's not too shabby. You could put that on your house, or you could put it into a good company. Some houses you might be able to get 5.6%, but I think most of them are up right around the 6% range. Under our capital management right now, we're looking at the company had $6.2 million in core operating cash flows. That left them a total burn rate of $1.0 million. CapEx was $1.5 million per day, and that left them a free cash flow of $1.1 million a day, or 288 days of cash. Now we got a new category this week. Added what I call their cash account, trying to reconcile their cash and see where all their money's going. This company, to balance their cash account, they underspent a little bit by about $970 million. But that could easily be accounted for through a repurchase of stock. That could easily taken care of that amount of money. And they did repurchase stock. And the interesting part about that is they're kind of they're shareholder friendly, because what's going on here is they repurchase the stock to offset the options that the shares of stock that were issued in options. So it makes them a management friendly company, and that's really helpful in any company you're ever going to own. They're had 18% return on equity. That's a little below average. They efficiently use their funds, and Walgreens is a cash cow. Basically what that means is they had a positive return on equity along with a positive free cash flow. Their expansion was up 4%. It was unsustainable. They're ahead of demand. And their expansion's gearing up. Being ahead of demand, of course, and unsustainable, you want to see that in the next period. You want to see that coming back down. You want to see them gearing it down or bringing in more revenues to cover that deficiency there. Under their asset management, their assets are selling at a premium. Not too bad, though. It's only 1.79 times the asset price of $20.36 a share. The asset values are rising, and they've got steadily rising tangible book values. All of those are excellent. Their assets grew at 5.9%. Return on assets was 11 cents. That's medium intensity. What that means is they generated 11 cents in earnings for every dollar of asset that they employed in the generation of making money. So There goes my screensaver again. I gotta fix that. Debt mix 1.8. That's average. Cash position 4%. And that's an improvement. They have some possible cash flow problems. Cash flows carrying the company. We'll get into that a little bit more here in just a minute. Their inventory management, they're possibly overstocking a bit. They're possibly facing a write-down. They've got 73.1, that's their percentage of inventory to current assets. That's high. You want to see that come down a bit. And I'd kind of like to see this company with turnover of 60 days rather than 66. So they've got about $1.25 a share too much in inventory. So you want to see that coming down a bit too. Okay, let's see, where are we at here? Their working capital, they don't quite have enough working capital. They've got 7.6 million in working capital, but for this particular type of company, it should be a little bit higher than that. And it is sufficient to cover their debt. Okay, and that's one thing I wanted to bring to your attention here, because their leverage of 66%, that's all payables. That's mostly where their cash flow problems are coming in. They've got a lot of payables coming due here, and that's all the debt they have, so you might want to be aware of that right there. Another new section we have this week is assessments. Okay, what we're doing here is we're looking over a 3-year period for sales, cash flows, and income statement. If you look down here in the lower right hand portion of your spreadsheet, sales were up, but they were slowing. Cash flows were down, they were slowing, and net income is up, and that was slowing. That's kind of self-explanatory. You want to see those trends rising, not slowing down, and you want to see them up, of course. Valuation analysis over here. We've got a fair value on the stock of $28.86. That overvalues the stock here a bit at $36.45 on their market price. Their year-over-year footprint, all burgundy here, except for bottom down here, financial cash flows, they fell. That was in line. You want to see that, but everything else was really in the negative. The company's got a negative credit rating. That's lower to mid-grade. That's not exactly going to have people dancing on the tables, okay? You know, you want to see that higher up. AA, AAA, somewhere up around there would be ideal for them. I don't have any positions in this. It was recommended by a fellow by the name of James Stack, too. That's about all I have for you this week on Walgreen Company. It's my own opinion of the stock. It's a pretty good stock. They just need a little tweaking. Make sure you read your footnotes down there at the bottom. And other than that, have a great week, Street.